further ado. Okay, of course now the clicker is not going to work. I think I just need to click out of that. Oh, clicker's not working. Technical difficulties. Oh, we got it. Okay, we can do this. So what are we here to talk about today? The Canadian tax system. So in general, in Canada, the way it works, unlike maybe in some other countries, every year you basically have to file your tax return and report how much money you made. And every individual is given a few options for deductions. And then there's some general credits that the government gives due to various government policies. And it's a self-reporting system. So a lot of people will get help either through an accountant or on campus. I hope everybody's aware that there's a volunteer tax preparation program that's run by the Sauder School of Business. But the only issue with that one is if you have any sort of complex situation like foreign income, or you're having to pay taxes and other income, or this is your first year in Canada, where you're coming from, let's say, the US or some other country, they may not be able to help you with a complex situation like that. They're kind of, I mean, they're voluntary and they are students, so you have to keep that in mind. But if your tax situation is relatively straightforward, you're just getting your tuition slips, that type of thing, maybe some scholarships, they can definitely help you and it's free. So that is definitely a good resource to keep in mind. I would also let you know right off the bat that in Canada, because it's a self-reporting tax system, so your tax return is supposed to be filed by April 30th. The only exception to that is if you happen to be self-employed, in which case it would be June 15th. And so the difference there being, if you're employee, you're receiving a T4, you kind of don't have any say, I guess you could say, in terms of when you show up to work, what type of work you take on, that type of thing. You're an employee. So you get your T4, you report it, that's April 30th. But if you're self-employed, let's say you're doing freelance work, gig work, that kind of stuff, where you can accept clients, reject them, then you have a lot more leeway to claim expenses. You're responsible for paying into your Canada pension plan, your EI. You're even responsible, depending on how much money you make, for paying GST or sales tax, GST and PST. But so they give you a bit of extra time. That one's June 15th. And if that's your scenario, I'm guessing the volunteer tax clinic here at UBC would not be able to help you with that. That one's a little bit more complex, but especially for grad students, that definitely could be some people's case. And I would also like to talk about some tax planning methods that will help people. Maybe right now it doesn't seem, as students, we may not have a lot of money. We may not be thinking about tax planning, but it's good to think about. And especially once you get out of the workforce, start making money, or maybe you're making money now, there's lots of ways that you can do things better and plan better and reduce your tax burden. And our tax system is set up so that planning is not a bad thing. I mean, everybody's entitled to do their own research or hire somebody and figure out the best way to reduce their tax burden as much as they possibly can. So I'm here to help demystify that a little bit, give some more information. And with regards to that, I'd also like to talk about some benefits, specifically with regards to students. Here we are as grad students for the most part, and we all probably have gotten our T2202 tuition statement by now. Hopefully, didn't just look the other way. Hope it went away. Now is the time to think about, okay, what do I do with that? What can I do with that? You know, there's various options. You can transfer that to your parents, let's say. You can carry it forward indefinitely to when you start making money, right? And so, and another thing I'll just say right off the top is a lot of people think, well, if I don't owe any tax, why am I even filing? What's the point? Well, technically, you don't have to file your tax return if you don't owe any money. So the April 30th is a deadline for, if you did earn some money and you do owe some taxes, you definitely do need to file and pay by that time. But let's say you didn't earn any money, all you got was your T2202 statement from UBC, then there wouldn't be a deadline. If you filed after April 30th, that'd be totally fine. They don't owe you anything, you don't owe them anything, there's no interest or penalties, nothing like that. But it is good to get into the system, the tax system, because a lot of times when you start applying for things like loans, maybe like in future, some people potentially apply for low-income bus passes or things like this after university. You typically, they'll ask for a copy of your tax return, or they'll ask for a copy of your notice of assessment, which is what the CRA, the government agency that administers the tax system, will give you once you submit your tax return to them. Then we're gonna go through some questions, top 5 questions that students ask typically, how to file, and then some general resources. So, no further ado, I'll go the right way. Okay, so where do our tax dollars go? So the way our system works, I guess probably the biggest one right off the top that just jumps out at me is our medical system. So if you get sick, you go to the hospital, they don't ask how much money you make first, they just check you in and take you, and then when you're healthy, you leave. And that is paid for by our taxes. That's one of the main reasons why our taxes are quite high in Canada as compared to some other countries. I mean, the combined federal and BC provincial taxes depending on your income level, is well above 50%. I think it's as high as 52, 53, something like that. So that's really, really high if you think about the government's taking half of your paycheck. Where's all that money going, right? So the medical system, universal healthcare, that's number one, really, in Canada. That's a lot of where it's going. Education, of course, universities are getting some money from the government, schools, national defense to some degree programs, which we also pay into, and there's some confusion maybe as in terms of, okay, if I pay income tax, why do I also need to pay EI? And why do I need to pay CPP? They're all taxes. The government's just decided to break down tax in terms of 3 different buckets and take it from you in 3 different ways. I guess you could think of it that way. CPP stands for Canada Pension Plan, in case you didn't know. Once you reach the age of 65, and if you decide to retire, then you can start drawing on that and you'll get a check from the Canada Pension Plan. And EI, that's employment insurance. So essentially that's our social safety net. That is in a case where, God forbid, you get laid off and it was not for cause, meaning they just had a redundancy, a decrease in the workforce. What are you gonna do? You don't have a job. Well, then you can collect EI in the meanwhile. So every time you get paid, you're gonna see that EI reduction, and that's where that's going. Okay. And of course, our national parks as well, and infrastructure, roads, bridges, and whatnot. So taxes, I think it's safe to say, we drive on the roads here, we use the hospitals here, we're here at the university, we all benefit from it. And so maybe we've had this idea that, well, the tax system are too high, I don't agree with it, but at the end of the day, it's the law. And of course, if you don't pay your taxes and you try to avoid it, there's gonna be penalties up to and including, well, first of all, they'll slap you with interest and penalties. And then if you still don't pay, try to avoid it, then they'll start seizing your assets. And so the Income Tax Act, which is the law for tax, it has the force of law of any other type of law, right? So the CRA is obviously not going to be, putting you in handcuffs and taking you to jail. But if you're not paying your taxes and they're going after you and sending you notices and eventually seizing assets, they're going to get court orders and go after you. So point is, you want to pay your taxes. You got to pay your taxes. This is law. This is something that we may not agree with it, but you know what? If you don't agree with it, that's where you go to your local MLA or politician and talk to them and say, where are my tax dollars going? I don't agree with this, and do it politically, right? But now that this is the law, it is what it is. We can't really avoid it. So, okay, here in Canada, the tax system. So as I said, it's a self-reporting tax system. So every year you basically get your slips, or if you happen to be self-employed, you would have, hopefully, maybe your accountant will help you. If you don't have an accountant, maybe you're just writing everything down for yourself and figure out how much money I made, what deductions I had, and generally speaking, any expense incurred to earn income, you can deduct as a self-employed individual. As an employee, it's a little bit different because the way the rules work is if you're an employee, you don't bear the risks and rewards of ownership. So essentially you're getting paid if the company makes money or not. So because of that, you don't get to claim a whole bunch of expense deductions, right? Like if you have a dry cleaning bill for being an employee, you don't get to deduct that. There's very, very limited expenses that you can deduct as an employee. Whereas as a self-employed individual, let's say you run your own business, or even Uber driver, let's say, you have all kinds of costs, right? Like you got to pay for gas, you've got to pay for maybe you're leasing the car, your car insurance, that type of stuff. All of that is going to be deductible because it's an expense incurred to earn the income. So I think that's kind of just the general rule. Employee, you don't get much because you don't bear the risks and rewards of ownership. Self-employed individual or sole proprietor of a business, any expense incurred to earn that income is eligible for deduction. I would just also like to say, the Canada Revenue Agency, they didn't write the law, but they enforced the law, right? So they're kind of like the police, I guess you could say. It's the legislature in Canada who actually wrote the Income Tax Act. And if for example, let's say we've got an election coming up, let's say the government changes, and then they decide, you know what, our taxes are too high, we're going to repeal a bunch of these taxes and reduce our tax rates. Well, they're going to have to do that in the legislature. It's going to have to go through a process, get passed. They're going to rewrite the Income Tax Act, and then that becomes law, and the CRA is tasked with administering the law. So I guess the key to note there is, if you get a letter or something from the CRA and you think that they're up to lunch, they don't know what they're talking about, this can't be right, they're not the last word on it. If they think of it that way, okay? Because they're just an agency charged and tasked with enforcing the law, right? Just like the police. So there's resources which I'll share at the end, but just to give you a quick idea, something like the Taxpayer Ombudsman Office, where essentially you can make sure that you're getting fair treatment with respect to the CRA. And they also have a general complaint line where, especially in the case of the CRA, the most common complaint I would say is undue delay. Is, let's say they send you a notice and they say, prove that you got this, and this deduction. You send all your information, and 2 years later you haven't heard anything. So that's probably going to fall under an undue delay category. You can get those resources to help you speed things along to get things moving. Okay, also like to say in Canada that, as I alluded to earlier, we got Canada Pension Plan and EI. We've also got sales tax, and just at a high level, CRA handles both, but what's the difference? So when you work as an employee, you're paying an income tax. If you run a business, you're paying an income tax. Now, GST, PST, on the other hand, there's sales tax. So what does that mean? Whenever you buy something, a good or a service, that's a sale, right? So in Canada, we have both. Some countries, they only have one or the other, but we've got both. And so I guess the kind of economic theory behind it is sales tax is probably more fair, more equitable, because it's your money, right? And you decide whether you want to spend it or not. You want to buy a luxury vehicle? Okay, fine. You're going to have to pay that sales tax. And that's fair because you have the money to do it. But an income tax, on the other hand, is whether you wanted to or not, that money, that tax is being taken off your paycheck. I don't know if you happen to notice, but your paycheck comes net of those taxes already being taken off. So we don't get a choice. But with sales tax, we don't have to spend that money. It's up to us, right? So both in Canada, we have both. So I hope that is clear. Okay. I kind of mentioned it a little bit earlier. How do you know if you have to file? So as I said, the case I gave earlier, let's say you didn't earn any money in the year and April 30 rolls around, you don't have to file. There's not going to be a no filing penalty, late filing penalty, anything like that. But there are really good reasons to file even when you don't owe money, such as, let's say in the future, you want to apply for a loan. Well, they're going to ask you for your most recent tax return, right? And I will also let you know that there's something called the statute of limitations for income tax returns. So when you file a tax return, and then what normally happens is the CRA almost immediately will send you what's called a notice of assessment, an NOA. And the NOA doesn't dispute anything. It basically acknowledges you sent your tax return. From the date of the notice of assessment, the CRA has 3 years to try and audit you and potentially reassess you and change your tax return if they disagree with you. So my point is, you want to always have that clock be ticking, because the CRA is having a certain window to audit you. If you don't file, that window is just carrying on forever, right? So even if you don't owe taxes, it's always good to to get yourself in the system and have that window being that clock, ticking down so that the CRA's window to audit you is basically going to elapse. They're going to become statute barred. It could be that the CRA would send you a request to file a tax return. That is really rare. That's kind of more in situations where, let's say you're not a Canadian citizen, you may not even be living in Canada, but maybe you bought or you sold a Canadian property, right? So normally you wouldn't file a tax return, you don't have to, but if you sold a property in Canada that you owned, Canada's gonna want to tax whatever gain you might have earned on selling that property, the difference between what you sold it for and what you bought it for, the gain. So that they could potentially, in that scenario, ask you, hey, we know that you sold a property, we want you to go ahead and file a tax return and tell us what you sold it for and what it cost back in the day. You'll calculate the gain, and you'll pay tax on it. There's also some other scenarios that you would want to potentially know about. In filing a tax return, so we'll get there, but there are a couple of interesting tax planning opportunities, like an RSP. Has anybody heard about RSP here? Yeah. Okay, so it stands for Registered Retirement Savings Plan, and essentially it's a government way to incentivize saving for your retirement. So the way it works is you open up an RSP. Anyone who's resident in Canada, you don't have to be a citizen, just resident in Canada for tax purposes, meaning living here regularly. Typically the threshold is more than 183 days. If you're in Canada for more than 183 days, then you're going to be deemed to be a resident in Canada. But if you came here, let's say from another country to study, then you're definitely going to be considered a resident in Canada. And Canada has what they call a residence-based taxation system, which is what I was saying. But the way it works is they tax your worldwide income. So let's say you're from the US, you come here, and let's say you earn some gig freelance income in the US. Now you're a deemed resident in Canada. So you're gonna have to file a tax return, report all your US income, converting it to Canadian dollars, as well as filing in the US and paying tax over there. But then you would think, well, what the heck? Now I'm gonna get taxed in two countries. That's not fair. That's double taxation. Well, Canada and the US have a negotiated tax treaty. And so what happens then is you'll get credit for whatever tax you paid in the US. Right, so we call that foreign tax credit. So you'll never pay tax twice on the same income with respect to a country where we have a tax treaty, right? And Canada does give foreign tax credits. So just know that if that is your situation. But what I was saying about the Registered Retirement Savings Plan is if you open one and you contribute money to it. So you're gonna be saving for your retirement. As you contribute, you're gonna get a tax deduction just simply for contributing. That's the government's incentive for saving for retirement. And then in future, this may be a little bit late now for us grad students, but you can borrow from your RSP and use it to pay your tuition. And so essentially you're borrowing money from yourself. Think of it that way. You're taking an interest-free loan from yourself, from your own money, from your own savings, and using it towards your education. And you might think, well, why don't I just do it against my own savings? What's the benefit? Well, the benefit is when you open an RSP and you contribute to it, you get a deduction for taxes, right? So you got a deduction going in, and think about it this way. Most people's tax rate combined, federal, provincial, is like, let's say around 20-25%, depending on their income level. So you got whatever you contributed, let's say you contributed $1,000. So you got $250 back just for putting $1,000 into that account, right? So there's your incentive right there for using money to pay for education from an RSP as opposed to just using your plain old savings, right? As you wouldn't have got that 25% back if you just put it in a regular old savings account. And by the way, in the regular old savings account, if it earned interest or dividends or anything like that, you'd have to report that and pay taxes on that every year. But in RSP, no. Any earnings, any growth, interest, dividends in there, all tax-free. The only time it becomes taxable is when you retire and you start paying it out as an actual income in retirement. So there's real benefits to these types of things. So lifelong learning plan is with the RSP, and the home buyer's plan is also another one from the RSP. You can borrow money from yourself, from your own RSP account, and use it towards a down payment on a house. Okay, so I kind of talked quite a bit about this. Yes, I would just say this, as opposed for the benefits of filing. Let's say the scenario I was talking about earlier where you don't owe anything, you don't have enough earnings this year to actually owe any taxes. So then you might think, why would I even bother? I don't owe them any money and there's no penalty for not filing. Well, the reason why you would do it is because, well, first of all, if you're under a certain low income threshold, you're going to get GST, HST credits, right? So the government's actually going to pay you cash back into your hands for being below a certain income threshold. And what is it? It's basically the government saying, well, you know what? If you make below this certain amount, then we're going to give you a little bit of benefit for having to pay GST and PST here because it's too burdensome to have to pay GST and PST on everything. So if you don't file your tax return, even if you don't owe the government anything, you're not going to get that money back, right? And so it's not much, but I think we're talking the GST credit, I can't remember off the top of my head, but I think it's only like 500 something right now, which they pay to you in quarterly installments, but still 500 bucks is 500 bucks. They may as well get it back. And then accumulating RSP rooms. So the way RSPs work is every year that you earn income is a year that you increase your room for RSPs. So basically there's a formula, and the formula is it's the lesser of a threshold amount the CRA tells you, which around now I think it's around $35,000, or 18% of last year's earned income. So let's say last year you earned $100,000, so 18% of that's going to be 18,000. So if the threshold is 35,000 and your 18% is 18,000, the lesser of those two is going to be 18,000. So your RSP contribution room is going to be 18,000. What does it mean? It means this year in 2020, we're talking about 2024 tax year. Let's always look back. You're going to be able to contribute $18,000 into your RSP. And then when you contribute it, you're going to be able to, let's just say your tax rate is 25%. You're going to get 18,000 times 25% back to you as a refund. So you get that refund right away, and that RSP amount is going to grow. You're going to go to a bank and they're going to invest it in something. Let's say whatever they're going to pick. They're going to pick stocks, ETFs, that type of stuff. So it's going to grow over time because you're not going to retire until you're 65 or whatever. So it's going to grow. All that growth is going to be tax-free. And in the meanwhile, let's say you want to buy a house, you can borrow from that RSP amount, and withdrawing from it won't trigger any tax consequences. You'll just have to repay it within a certain amount of time. But let's say you put in money in an RSP and then just take it out because you need it. Well, remember, you got 25% back just for putting it in. So the government's going to want that 25% back. They're going to get it back. So just taking money out of an RSP is a bad idea. You're gonna get hit with the tax bill right away. Putting it in, very good, because it gives you flexibility in terms of lifelong learning plan, paying for education, or first-time home buyer plan, paying for buying a house. So that's why you want to accumulate the RSP room, because as you earn more money, you're going to want to be putting more into that RSP. Okay, RSP versus TFSA. So I've talked a lot about RSP. Let's now talk about TFSA. So TFSA is tax-free savings account. Essentially, it's not as good as an RSP. Why? Because an RSP, remember I said when you contribute, you're going to get that 25% back. And I'm just using 25% as an example. It depends on how much money you earn, what tax bracket you're in. But basically, whatever your tax bracket is, let's just call it 25% for argument's sake. You contribute that amount, your 18,000, 25%, you get it back as a refund right away. Now, TFSA, you contribute to it, you don't get anything back. And then you think, okay, well, RSP is way better, right? Yeah, it is way better. But the thing about the TFSA is you have way more flexibility. You get to put it in tax-free and you get to pull it out tax-free. RSP, the only time you get to pull it out tax-free, well, there's two scenarios. If you're going to buy a house for the first time, or if you're going back to school, then you can pull it out tax-free, but you still have to pay it back. It's as though you've taken a loan from yourself and you have to pay it back over 15 years. versus a TFSA, it goes in tax-free, comes out tax-free. So what's the benefit? You might think, why don't I just put it in a bank or a savings account? What's the difference? Well, the difference is, let's say you're really smart and you're really good at investing and your stocks go through the roof and you make a lot of money. Well, if that was just held in a regular old bank account, guess what? You gotta pay tax on all those gains. But if it's in a TFSA, you don't have to pay tax on any of that, right? So it's still really attractive. It's very, very attractive. And again, it's a government policy is to encourage you to save for your own retirement. RSP is the government wanting you to save for retirement. TFSA is the government wanting you, not necessarily for retirement, because you could pull it in and pull it out tax-free, but just to have savings, in other words. So that's the government is incentivizing this behavior. First time home savings account, or pardon me, first home savings account is very, very new. I think it came out in 2022, if I'm not wrong. But essentially, you may have heard in Canada, we have a housing crisis. And so with rising costs of homes, especially here in Vancouver and some other markets, the government is trying to find ways to help Canadians save for a down payment to buy a home. So this is what they came up with. And this one is also very, very good because it's the same methodology, I guess you could say, as the RSP. When you contribute, you get a tax deduction immediately, right? So it's similar to the RSP in the sense that you pay into it and you're going to get your 25% back right away as a refund. Now it's capped at $40,000 lifetime. So every year you can contribute $8,000 per year. So it's not like you just, go to the bank and say, hey, I want to open a first home savings account. Here's my 40 grand. No, that's not how it works. Every year you get $8,000 that you can contribute up to a lifetime amount of 40. And so again, the bank's going to take that money. They're going to invest it in stocks or whatever you ask for. It's going to grow and they're going to earn dividends, all that stuff. That's all going to be tax free. And then once you eventually are ready to buy a house, your first house, then you can pull that money out tax free and use it towards a down payment. Now, what happens if you don't end up buying a house? Well, then the government thought of that and they said, you could transfer it to an RSP with no tax consequences. So this is very attractive, I would say. Even if you're not sure if you ever buy a house, I would recommend opening one of these. I think it's not a bad way to save for the future, I would say, because you never know if you're going to do it. Okay, so there's all kinds of different types of it. First-time home savings accounts. I probably won't bore you with these, but basically, there's a lot of different ways that you can actually save. I would say the most common would be you go to the bank and you say, I want to open a first-time home savings account, and they'll give you a questionnaire and ask you basically, what is your risk tolerance? What type of, what's your investment horizon look like, right? Because if you're talking about 40 years down the road, they're going to be picking some really risky investments right now, because over 40 years, even though it might go up or down like crazy right now, but on a long enough time frame, it's actually eventually going to go up. But if you're thinking about buying it in 5 years, they're probably going to pick some really risk-free stuff that's not going to grow very much, but it's also not going to go down very much, right? So, yes, non-taxable income. Okay, so this one, the most important, yes, please, yes.
Just put the first one by
Yeah.
Is there a limit of like the time you have to use it by?
Yeah, that's great. And I apologize, I didn't say that. So I will just repeat the question for the sake of Zoom. But so the question was, with the first time home savings, is there a limit by which you have to use this? And yes, the limit, I believe, is whatever comes first, 14 years from opening the account or reaching the age of 7, whatever comes first. So, I mean, for most of us, that's going to be the 14 years, right? But the idea there is that once you reach 70, that's kind of like a deemed mandatory retirement age anyway. So it's going to go into that RSP that way. And then another interesting question, because every year for RSP, you have to have what's called RSP room, right? And remember, that's based on that formula of the lesser of the amount the government tells us every year, which this year is like around 35,000 or so, or 18% of last year's earned income. And in my example, let's say you earn 100 grand, then that's going to be 18,000. And the lesser of those two is going to be 18,000. So every year you've got RSP room that's accumulating. What if you used up all your RSP room and then you didn't buy a house? Can you still transfer that first time home savings into your RSP? The answer is yes. Even if you have no room left, you're still able to transfer it over. So they're really generous with this, I would say. Okay, non-taxable income. For us, for students, I would say the most relevant one, obviously, is gonna be the scholarships and bursaries. So I'm sure some of us did get some scholarships and some bursaries. So there's various different types of scholarships and bursaries. But you just need to know that some of them are gonna be tax exempt, meaning you can report them, they'll come, I think it's on box 105, can't remember, on your T4A slip. And then it's basically not even gonna appear on your tax return. Or if it's gonna appear, it's gonna be an in and an out. They show the income and there'll be a deduction, an exemption, right? Because certain scholarships, most of them for full-time students are exempt. We're not taxing them, right? But let's say you're already working and your employer gave you some kind of a grant to take a course part-time or something like that, then that's not the case. Then it is gonna be taxable. And in that case, it's usually only the first $500 that's exempt. Anything above $500, they're gonna tax. But for most of us who are full-time students who are winning awards or scholarships or whatnot, it's gonna be 100% exempt. You still have to report it, right? And so maybe keep that in mind, either if you're planning on doing your own tax return, or if you're going to the volunteer tax clinic here at UBC, or if you're doing it through an accountant or anybody like that, just make sure that it's exempt. In other words, you should be asking that question, hey, is my scholarship causing me tax? Because it shouldn't be. Just make sure, because that's easily missed, I would say that. And a fun fact, in Canada, lottery winnings are not taxable. Unlike the US. In the US, if you win the lottery, that's taxable, right? But here, it's not. But there's still sales tax. So you can't quite win, but there's no income tax on that. So that's pretty interesting. The other ones, I don't really think we can talk about them if you want, but I'm gonna go past them for interest of time because I think scholarships is the main one. Okay, special benefits for students, yay. RESP, okay, this is another interesting method that a lot of people use to save for their kids' education. So maybe a little bit late now, but essentially the way it works, or the scenario where this applies is, let's say you just have kids and you're thinking that someday they're gonna wanna go to school. So what do? You open what's called a Registered Education Savings Plan, RESP, and then it's similar in this, it's very similar to the TFSA. You don't get any benefit for putting money in, and there's no tax impact for pulling it out. But when it's in that account, you know, your broker, your financial planner, your bank, whoever, they're gonna invest in some stocks, it's gonna go up, it's gonna earn interest, all that earnings is gonna be tax-free. But on top of that, whatever you contribute, the government is gonna match up to $500. So I believe you need to put in, I think it's $2,500 for them to give you that 500. So anything, if you contribute, let's say only 2,000, you're not gonna get the full $500 match from the government. So think of it this way. If you have kids and you're thinking of their future education, if you didn't open one of these, you'd basically be leaving government money on the table. I don't know why you wouldn't. I mean, it's, if the government's offering $500, you know, I would probably say yes, please. So then you may as well. And then a lifelong learning plan. This one I talked about earlier for RSPs, Registered Retirement Savings Plans. Just a quick recap. So Registered Retirement Savings Plan is intended for you to save for your retirement. Every time you contribute to it, you're getting your tax refund back, your 25%. Again, 25% is just an example. You're getting your refund. And so slowly over time, this RSP is invested in different types of investments. It's increasing in value. And then by the time you hit 65 or whatever you want to retire, it's grown over the, 30, 35, 40-year career that you had. And it's hopefully enough to retire on. And then you're going to be slowly taking withdrawals from that RSP in retirement, kind of like a salary. And typically people in retirement, their costs are way lower, right? Like their kids are already off doing their own things, hopefully, maybe not nowadays with costs, and hopefully you don't have a mortgage anymore, right? So your daily living costs are way, way lower. So what you're taking in retirement is less. What does that mean? That means also your tax bracket that you're in is also less, right? So you need less money too into retirement. But along the way, let's say you put in 30 grand into your RSP and after working for 5, 6 years, whatever. And let's say you decide, you know what, I don't like this job, I don't like this career, I want to go back to school and get a master's degree. Well, guess what? You can borrow from your own RSP. You can take money out of that and use it to pay for your education, right? And it's tax free. You got a tax refund for putting the money in, but you get to take money out to pay for your education tax free. Yes.
Does like bursaries count as income for like the percentage that you're talking about?
Yeah, okay, so the question for Zoom, do bursaries count as income for this earned income? Yes, I believe they do. I believe they do. So stuff that wouldn't count would be like, for example, let's say your income is only dividends or royalties. I mean, this is really rare. Why would anyone have this scenario? But it's kind of a rich person problem, honestly, because basically, if you're only earning dividends, interest, passive income, that's not going to be counted as earned income, right? And so if your earned income is zero, the lesser of 18% of zero and the government threshold of 35 grand is obviously going to be zero. So your room to contribute is also zero, right? So when you first, let's say you're an international student, first get to Canada, you can't contribute anything, right? And so this is part of the reason why you want to be earning at least something, at least some kind of money, and or like you just said, your bursaries, and that's why you want to be filing your tax return, right? Because you report that bursary, it's your income. Now they're going to apply the formula 18%, and now you're building up your RSP room, right? And so next year when you file your tax return, you're going to be able to contribute to it and get a deduction for doing it, right? And all the while save for your retirement. So it's certainly incentivized, I would say. Moving expenses. This is another one that if you had to move for work as the slide saying to go to full-time different education institution, and it's got to be 40 kilometers more. So let's say you move from Toronto or some other place like that. That's going to be eligible. So you're going to be able to deduct certain moving expenses along the way, and it's quite expansive. We're talking about the U-Haul. We're talking about meals and entertainment along the way up to a certain threshold, and meals and lodging too. So this could be very, very valuable and certainly could be applicable. Yes.
Yeah, we have some questions in Zoom.
Oh, okay. For this particular stuff or?
Yeah, 5 questions.
Yeah, maybe I can handle those Zoom questions at the end. Yeah. So apologies, Zoom people, I can't see that. So I will get to you. Okay. Charitable donations. Okay. So this one fairly self-explanatory, things like churches, I think even the school, UBC, in case you weren't paying enough fees and you want to donate some money. But typically nonprofits, schools, churches, that kind of thing. What's the benefit? Well, you get a very large tax credit for that. So I should have apologies. I should have said this at the beginning, but the way our tax system works for individuals is we have tax brackets, right? So we have a progressive tax system. What does that mean? It means if you make below, I believe the threshold right now is 57,000 or so, and this is just federal. So if you make below $57,000, you're only going to pay tax at 15% federally, right? BC's got their own thing on top of that too. But let's just talk federally for a second. So the government, when they give you credits, they only give you credits at that lowest tax bracket rate of 15%, which is not great because let's say you made 100,000. Now you're not in the lowest tax bracket anymore. Now you're up in the 25-30% tax bracket. But still, if you gave charities a different example, but let's say you have a credit, you're only getting credit at 15%. So you're paying tax at 30, you're getting credit at 15%. So keep that in mind when you think of credits. But donations are a little bit different in the sense that and I don't exactly know the policy reason behind this. Maybe they're thinking, people, they're just trying to encourage generosity and they realize not-for-profits, churches and other things, this is their main source of income. So to make that happen and ensure that that would happen, only the first $200 is going to give you credit at 15%. Anything above $200, so let's say you gave 1,000, is going to get a 29% credit rate. So when I say credit, let me just back up for 1 second. So when you earn income, let's say $100, tax rate is only going to be 15%. So you pay tax 50%, so that's $15, right? So if you got credit at 15%, that would be let's say you gave $100 donation, you would get $15 credit, right? So your $15 tax would be exactly offset by your $15 credit, right? So tax is offset by credits. Now, there's a difference, I should have told you this earlier, and I apologize, between a deduction and a credit. So a credit is, as I just illustrated, a credit is dollar for dollar, right? It's the after multiplying by the rate. Think of it that way, right? My $100 income, I'm gonna pay 15 bucks of tax at 15%. My credit, $100 donation, $15 of credit, right? So it's after multiplying by the rate. What's a deduction? A deduction is before multiplying by the rate, right? So what's a good example? I'm an Uber driver, right? And I make $100 and I had to pay $10 in gas. So I get to take my $100 minus my $10 in gas, and now my net income, what I really made after expenses is 90. So now the government's gonna charge 15% on 90, right? So that's a deduction. So I hope that makes sense. And yeah, so donations, you definitely get, the more you do over $200, you get 29%. So that's quite generous. But most other credits, like let's say medical expense and that kind of things, 15%. By and large, most credits, 15%. So you're paying tax potentially at a higher rate, you're getting credit at the lowest tax rate. So keep that in mind. That's what I was also about to say. Childcare deduction. Okay, so this one has to be claimed by the lower income spouse, assuming you're married or common law, and filing together. Actually, no, that doesn't even matter. I take that back. It doesn't matter. So it's between the two parents, regardless of their marital status. The lower income spouse is going to be the one who's going to claim this childcare deduction. And so what are we talking about? We're talking about like daycare costs, boarding school, that type of stuff. But yeah, and this one is, remember, this one is a deduction. So if you had your $100 income and your childcare costs were $10, so you're gonna go $100 minus 10, now my net income is 90, and I'm gonna multiply that by 15%, right? So keep that in mind, that's a deduction as opposed to a credit, like the donation was. Okay, I talked about this a little bit earlier, but back to my example of what's the difference between an employee and a self-employed person, like the Uber driver versus the guy who, I don't know, works at McDonald's. So the guy who works at McDonald's, he gets a paycheck whether McDonald's is making money or not, right? So because of that, the government says, well, you don't get a whole bunch of deductions because you're not really the one who's gonna pay the price if your business doesn't succeed, right? You kind of have a guaranteed income. But on the other hand, let's say you were the Uber driver, there's no guarantee you're gonna make money. What if your vehicle expenses outweigh or exceed your income? Well, then you're gonna have a loss, right? So the government takes that into account and says, okay, if you're self-employed, you're gonna get all kinds of different deductions. And remember, as I said at the beginning, the rule is as long as those expenses were incurred to earn income, that's the rule, right? So you can't do a business out of your house and then say, I bought a new couch and I just want to deduct that. No, that's not going to count, right? It obviously has to be directly related to earning that income. I mean, if you happen to be working off your couch, sure, you could do that, right? But not personal things. And that's why the list here is stuff like dry cleaning, clothing, bank charges. Typically, those types of things, even though let's say you get a professional job, you got to work and wear a suit and all of that type of stuff, you've got to pay for dry cleaning. You don't get to deduct that. You're an employee. That's just the way that the government has decided to break it down. Okay, so the top 5 questions. What's the tuition credit? Okay, so the tuition credit is every time you pay your tuition every year, you're gonna get that form, T2202, which is gonna tell you how much tuition you pay per semester. It's gonna tell you how many months during the year you were full-time versus part-time. And then let's just say you're a student who didn't earn any money. That's all you had, just a T2202. Right? So why would you file that return? Well, what about if your parents were the ones who paid for your education? Well, what the government has done is they said, okay, we recognize there's situations where parents pay for kids' education. So we're going to allow you to transfer that credit to your parents because we recognize that you're a student, you're not making any money, but they are, right? That's probably how they funded your education. So that could be very valuable. But keep in mind that has to be the one who earned the credit, the student, has to give it. It can't just be forced because you're my child. If you know what I'm saying. They actually have to be the one giving that credit, right? So, and then you might ask, well, does the credit ever expire? I'm gonna be studying for a long time. I don't know when I'm gonna make money. No, the credit never expires. It carries forward forever, right? Well, not forever, but as long as you're alive, you can use this credit, right? And it's very valuable because essentially what it does is once you start earning money, now you get this massive deduction, this decrease of your taxes for having studied. So it's the government's way of subsidizing study, right? Is they give you a tax break for having paid tuition fees all those years. So it's very, very useful. Oh, and I should have said, it can be transferred between spouses as well. So let's say, you married and your spouse is working, making 100 grand, and you're a student and you're not making any money. Well, you have a choice. You can either say, you know what, I'm gonna hang on to that credit because I think I'll make more money than you later on, and then take it. You could do that. Or you could, in the first year, you could just transfer it directly to them and they'll get a refund right now, right? So, and keep in mind, there's this other finance term, they call it time value of money. Essentially it means money in your hand right now is worth more than money in the future, right? Why? Because of interest. You could have earned interest on that money had you just put it in the bank. So keep that in mind when thinking in tax planning. Is it better for me to get a refund right now? Or is it better for me to wait until I start earning money and then I'll use it, right? So to be able to get credit for that, to let the CRA know that you have access to this tuition credit, that's a reason to file your tax return right there. You're not earning any money. There's no penalties for not filing your return. But you want to just file it, even if all you get is a T2202 from UBC, and then the CRA on their My CRA website is going to track, okay, this person has X amount of tuition credit, and we know that in a future year when they start earning money, they're going to be able to take that as a deduction. Okay. Question 2, do all courses at college, university qualify for tuition credits? Yeah, the courses definitely do, but yeah, so there's certain ones that don't. Okay, so post-secondary level, yeah, I would say like here, obviously here at UBC, that's certainly a slam dunk. I think, I can't remember the criteria off the top of my head, but I think it essentially has to eventually lead to a degree, right? So let's say you just take a random seminar on learning how to trade crypto, right? That's not going to count. You're not going to get a T2202 on that, right? But let's say you're go to an accredited university or college, and you're going to eventually earn some sort of degree. Yes, that definitely will qualify. Okay. Do all courses at college, university qualify for tuition credits? Yes. Oops, I'm going the wrong way. Pardon me. Got my thing. Yes. Okay. So these slides from CPA Canada are a little bit more versed towards high school students going in to university for the first time. So these may not be as relevant, I would say, but let's just take the example here at universities that, yeah, and no matter what course you take as part of your program, it's definitely going to be qualifying for that. Okay, can I carry forward tuition credits? Oops, already gave that one away. Is yes, you can. You absolutely can. They carry forward unless you either give it to your spouse or your parents. What type of student loan interest is claimable? Okay, so that's another very important one, is that you get a deduction if you took a loan to be able to study and you had to pay interest on that loan. Now, if it was a government loan, typically they don't charge interest while you're a student. Typically there's a grace period while you're studying where there's no interest accumulating. And then as soon as you graduate, then the grace period ends and then you start repaying it and they charge interest. So whatever interest they charge every year, you should keep a note of it and take a deduction on that. That is absolutely a valuable deduction that you can claim. Okay, so how to file. For anybody who's new to Canada, let's say, it's your first year in Canada, first year filing. So typically when you arrive, and especially as you're becoming a student, you would have gotten information on how to apply for a SIN number, a social insurance number. Hopefully you've all got that by now. If not, I would apply for it as soon as you can. you get your social insurance number, and then you, actually, I think you would have needed it for the university to be able to give you your tuition credit form. So certainly you probably have it done by now. Then you're gonna get all kinds of tax slips, like let's say you put some money in the bank. They're gonna send you what's called a T5, which is basically just gonna show you how much interest income you earned, right? Anything T for tax, if you work for a business, you're gonna get a T4 as an employee. You study at school, you're gonna get T2202. So you gather all these T slip documents, right? And then you either go to the free volunteer tax clinic here at UBC, or you can do it yourself. You can go to TurboTax and you can essentially try and do it yourself, figure it out. That's an option. You can also hire an accountant like me. You can find somebody to help you do that, which, I'll be answering questions at the end. If you have questions for me, please, certainly I'm happy to help as much as I can. And there's also this community volunteer income tax program, which I volunteered for before. Essentially, this one is outside of university. If you qualify with a certain low income threshold, then basically accountants such as myself would want to give back to the community, and you come with your slips, we'll do your tax return for free and call it a day. But it's a certain income threshold. So if you're making 100 grand, you obviously can't show up at the volunteer income tax clinic and say, hey, can you do my taxes for free? No, we're gonna turn your way. So, but if you're making, I can't remember what the threshold is. I think it's maybe 35 grand or so. Then you can obviously get that. Free tax software. So I mentioned TurboTax. Here's some other ones. I believe TurboTax is charging, is it $34 now? 30 something, right? So, and if all you have is a couple of slips, I mean, honestly, you may as well go to the free volunteer tax clinic here at UBC because it's free. And if all you have is a couple of slips and your situation's not that complicated, I don't see why they couldn't do it. So you may as well save yourself some money. But if for whatever reason your situation is more complicated and they say, no, sorry, we can't help you, then, TurboTax might not be the smartest idea either, because what if you get it wrong, right? What if you forget something or miss something, right? Because the thing is, in the tax system, it's not really a defense to say, well, I didn't know, and it's not really like the CRA is not going to accept that. They're not going to, or even if your accountant or somebody did it wrong, you can't, the defense is not, oh, my accountant did it wrong, blame him. No, it's the person who filed the tax return who's still responsible, right? So it's important to get it right. I think, like anything in life, you get what you pay for. So if you have a complicated tax situation, may as well go to some actual accountant, right? And get them to do it. But if it's relatively simple, just a couple slips, then take advantage of the free clinic here at UBC, I would say. Okay, has anybody heard about my CRA in this room? Yes, I see some nods. So I'll just say it anyhow, but my CRA is basically, you register online and any notice, any communication between you and the CRA is gonna go into an email account inside the My CRA login. And so when you submit your return, you'll get what I mentioned earlier, the notice of assessment, and that comes almost immediately. It's nobody's checking anything like this. It's just a system generated acknowledgement that they received your tax return. Why is it important? Why do they do that? Because as I mentioned earlier, the date on that notice of assessment is the date that the 3-year clock starts ticking for them to be able to audit you and reassess you and all of that. Once those 3 years have passed, they can't get you. You're statute barred, right? You're home free. So it's very, very useful to register. I highly recommend it because let's say you move and all your notices from the CRA go to your old address, right? That wouldn't be good. You can input your direct deposit banking information in there. So if you have a refund coming your way, it will go to the right place. You can track all of your, remember I was talking about your RSP contribution room? That's all going to be in there for you, right? So you'll know how much money I can put into an RSP and TFSA and FHSA as well. So it's very useful. I highly recommend it. But if it's your first year in Canada, then you're going to have to file a tax return first and then apply. So I hope that makes sense as well. Okay, here's some good resources that mentioned earlier, and we can share this PowerPoint later, or you guys can take a photo or screenshot or whatever, but these are all very good resources for how to do your taxes, some options for who can do your taxes. So keep that in mind. And now, question time. And then there was some Zoom questions, or, oh, let me go to that. Yeah, I'll just try to go one by one. Can't hear anything, that works, okay. Okay, Ruth. Hello, I've been reimbursed for a number of items by my department, including conferences, travel insurance, etc. Do I need to declare these expense claims and how do I do it? No, you don't. So reimbursements are not income. So basically, if you think about it, your costs incurred in the course of employment, most people would think about it from the perspective of, can I claim a deduction for having gone to this conference or this, that? So if you spent your own money to go to a conference, yes, you probably could claim that as a deduction. But if, let's say you spent your own money and then the UBC paid you back, no. And so it's not income and it's not a deductible expense. It's a nothing. It's a plus minus equals zero, if that makes sense. Okay, next one. If my friend just arrived in Canada on 1st January 2025, does she need to file a tax return even if she is not a tax resident in 2024? So the answer to that is no. So basically you become a resident in Canada when you arrive, depending on why you're here. So if you're coming here to study full-time permanently, then it's going to be Jan 1 when you arrive. So they're going to have to file a 2025 tax return, which will be due April 30, 2026. But in 2024, there'll be a nothing. And then it says, and if he or she files a tax return, does he or she include all the income outside Canada in 2024? So no, right? So if you were not a resident in Canada in 2024, then they can't touch that. But if let's say they earned income in the US in 2025 after they became a Canadian resident, then guess what? You're gonna have to report your US income and your Canadian income because Canada taxes worldwide income. Okay, I don't have a SIN number in my tax form provided by the university, as I forgot to provide one. How will that affect my tax filing process and how to work with this? Okay, so what you're gonna have to do, I don't know if you've applied for your SIN number yet, so you gotta do that. Go get your SIN number, and then I would think that you could be able to you should still be able to use it and file your tax return even without a SIN number because the name will match. Or if possible, but I think this will take some time, is you can go back to the university and say, hey, look, here's my SIN number, please reissue the T2202, and they should be able to do that for you, but that's gonna take time. But like I said, I think number one, get your SIN, and then number two, I think you could file your tax return with the slip that you have it as is, because your name's gonna match. Okay, I received a check of $202 yesterday from the CRA. I was surprised that the amount was reduced from 211 in 2023 to 202 2024. Then in 2024, I had opportunities to work. What expense the difference? Okay, so I'm not 100% sure what this relates to, but I think what you're talking about is the GST credit, if I'm not wrong. And so every year the government basically determines, okay, what income threshold they're going to allow to be eligible. So let's say you made 100 grand, you're not going to get a GST credit, but let's say, I can't remember what the threshold is. I think it's 45 grand. If you made less than 45 grand, you're going to be eligible. And then you're going to be receiving these quarterly checks, right? And so it could be that maybe you started earning a bit more income in 2024 as compared to 2023. And so it reduced that credit that they're giving you, right? Because it basically, once you're above their threshold, it starts to grind down slowly. So that could be the reason, but I'd need to know more. Okay, can you clarify if the grad student stipend is taxable? If it is, I'm originally from Ontario and work remote from an Ontario company. Oops, can't see that. I'll be filing taxes in Ontario. Am I able to include the UBC documents T22 and 224? If applicable in the tax file Ontario. Yeah, okay, so the stipend, so basically any income is taxable, right? So whether it's a stipend, so the stipend is going to be it depends on how it was received. If it was received as a T4A on on a T4A in box 105, I believe it is, then it's more likely, like in a grant or an award, right? But a stipend, I think it's gonna be treated more as an income, right? Because I think it's on the condition of doing certain things as a grad student. I don't think it's an award. I don't think it's just you get it because you applied. I think you actually have to do certain things. So it's gonna be treated more like it's employment income. So you're gonna have to claim it as income. And then the way it works in Canada is you basically do only one tax return. Doesn't matter which province you're in. Obviously, you have to tell them which province you're in, but there's no separate Ontario tax return. The only province where you have a separate personal tax return is Quebec, because they decided that they wanted to handle it themselves. They didn't trust the federal government to do it right. But every other province says, you know what, federal government, you do it for us and you just give us whatever's owing to us as the province, right? So there's only one return you need to file. Doesn't matter you're in Ontario. Okay, my 2025 RSP contribution room was auto-filled for me. As an international student, am I eligible to contribute? If I'm still a student, do I need to contribute? Okay, so I think I probably answered this already, but let me just answer once again. So the only way to get contribution room is, remember, it's a formula. It's a lesser of the government threshold amount of, let's say it's 35,000, can't remember off the top of my head, or 18% of the prior year. So in your case, 2024's earned income, right? So if your 2024 earned income was 0, 18% of 0 is 0. So in 2025, your contribution room is going to be 0, right? So if you contributed when you had no room, then you're going to be charged interest, you're going to be charged penalties, and you're going to have to immediately withdraw it, right? So contributing to an RSP without having any room is a really bad thing. And you don't ever need to contribute to an RSP. It's obviously optional. It's the government's way of helping you to plan ahead and save for retirement. But it's definitely recommended if you have room, because you get a tax break for doing it. You get a tax refund. Okay, what are the basic personal amount and total non-refundable tax credits? Okay, great question. So basic personal amount. So basically what it is, if you look, it's right around 15,000, 15 something. What it is it's basically, if you made less than $15,000, the government's not going to charge you any tax whatsoever, right? So let's say your income was 12,000 this year. So what you're going to do is you'll report 12,000 as income, and then you're going to claim this basic personal amount as 15,000, and your income's going to be totally wiped down to nothing. So no tax. But anything above that $15,000 threshold, you will obviously have to pay tax on. And that's just the government's arbitrary decision that, you know what, 15,000, you're not making enough money, so we don't want to burden you. We're not even going to charge you the lowest bracket, 15% rate. Okay, total non-refundable tax credits. Okay, so there is such a thing, and I didn't get into it in this presentation, as refundable and non-refundable tax credits. So refundable means, let's say you reduce your tax to 0 using credits, and let's say you actually reduce it even below 0. So if it's below 0, it's negative, so that means you get a refund. So therefore it's a refundable tax credit. But certain credits, like the basic personal credit is a great example, is non-refundable, meaning if that $15,000 basic personal amount reduces your tax situation to negative, the government's not going to pay you. Right, so it can only reduce you to 0. Non-refundable means it can only get you to no tax. It can never give you a refund. Okay, should I file my taxes if I've been here only for 3 months, including the last 12 to 13 days of 2024? Well, that's a very interesting, unique situation, because it would depend on what you're here for, right? Because the rule is, if you come to Canada for more than 183 days, then you're deemed to be a resident for tax purposes for the whole year, all of 2024. So that's a bad situation. But if you come, let's say, for, like you just said, for the last 12, 13 days, so now it depends why you came. So if you came with the intention of moving here, like you got your PR, whatever, this is just a random example. Let's say you got your PR and now you moved to Canada. So the answer is yes, you are going to have to file your tax return for 2024, even if it's only the last 12, 13 days. Why? Because you came with the intention of becoming a resident, right? The 183-day rule is only meant to catch people who periodically go back and forth between Canada, the US, and other countries, and they kind of try to like trick the tax system by being here, not being here, being here, not being here. But if your intention was to permanently move, then yeah, you're in. Will this recording be emailed? I don't know. That's a good answer. Okay. I received 2 T4A slips, but I'm unsure where the amounts are from. Is there a way to find out? Yes, absolutely. So, the issuer of the slip, like this is probably, I'm guessing, coming from UBC. So T4A is typically for your awards, your bursaries, your scholarships. So it's, if you don't know where they're coming from, it's possible as part of your program, when you applied, they automatically considered you for certain scholarships and awards and things like that. So what I would do if I was you, I would go onto your, we used to call it Student Center, what do we call it nowadays? What is it? Workday, yeah, go onto your Workday, and then you can actually see, I believe it shows on there any income you earned, any scholarships you earned, and your tax, slips. I believe it's on there. If not, then I would just go to your, supervisor, your department head, and just say, you know, I just don't even, I mean, it's kind of funny because it's a scholarship that you earned, but if you didn't even, you know where it came from, you could certainly ask and they'll tell you, but that's probably what it is, especially if it's box 105. I believe it's box 105 for the bursaries, for the awards. And remember, if it's an award and you're a full-time student, and I'm talking like, you know, a grant or award, something like that, it shouldn't be taxable. So you report it, but you won't be paying tax on it. Okay, tax filing platform asked me to specify the type of award. Yeah, that's what I'm telling, is it needs to be, so, I mean, it depends. I don't know what it is. You need to figure out what it is first for me to tell you, right? So, if it was an award, if it was, like a grant, a scholarship, that's not gonna be taxable, right? Make sure that it's fully 100% excluded in whatever tax software you're doing. Okay, also, what's the difference between full-time and part-time scholarship tax purposes? So part-time, I'd have to double check and get back to you, but I don't believe part-time students get 100% exclusion for scholarships. I don't think they do. I think they only get the first $500 exclusion, right? So let's say you're a part-time student and you get $1,000 scholarship, then you're gonna have to pay tax on 500 of it. Only the first 500 is gonna be exempt. Okay, what if I worked in 2024, but I get paid in January 2025 for that period? Should I file this income for 2024? Yeah, it doesn't matter when you get paid. So basically, and this is interesting because it depends on what kind of work we're talking about here. If we're talking about, let's just say McDonald's, and for whatever reason, you started like the last day of 2024 and you earned certain amounts in 2024, and they gave you a T4 slip, then yeah, you have to report it. But they didn't actually pay you the money, the cash until Jan 2025. Doesn't matter when you got the cash, right? It's what the tax slip says. Now, if you're talking about your own personal side gig business, right? So the rule is when the money was earned, right? So when did you sign that contract? When did they agree that they're gonna give you that contract or you're gonna do the work? When did you do the work to earn the money? That's when you should pay the tax. Okay, how soon can a contribution be made to a TFSA if he or she arrives in Canada on Jan 1, 2020? Okay, so you can't just go and open a TFSA if you arrive on Jan 1, can't do it. You gotta file a tax return for 2020, for the first year that you're a resident. So let's say, so in this case, you're not gonna be able to do it until 2026 because TFSA contribution rule gets established by filing a tax return, right? And so if you came on Jan 1, 2025, then you're not gonna have a tax return until, it's not gonna be due until April 30, 2026. So April 30, 2026, so basically next year, you're gonna file your tax return proving that now you're a resident for income tax purposes, and then the government is gonna show on your MyCRA website, hey, here's your $7,000 of room to contribute, and then you can contribute, but right now you can't, unfortunately. For no tax bank savings accounts, if CRA allows a contribution of X dollars and I invest exactly X dollars, what happens when, so let me just keep doing that, when there's interest on that account and the money goes above the allowed X dollars? So I'm struggling a little bit to understand your question. So it allows a contribution of X dollars and I invest exactly X dollars. What happens when they invest, when the interest on that account and the money goes above the allowed X dollars? So I don't really think that matters. And so when you say CRA allows a contribution, okay, I think I get your question. I think you're saying, it's a TFSA and your contribution is $8,000. That's your room. So you go to the investment firm or the bank or whatever, you put in $8,000 and let's say your investor is really smart and it starts earning money and now, next month it's $9,000. Well, that's what I was trying to tell you earlier was the TFSA is tax-free. Any earnings within the TFSA are all tax-free, right? So when you say no tax bank savings account, I think what you're talking about is a TFSA. So any earnings, any increase is gonna be tax-free as long as so put it this way, when you first contribute, it can't be more than the $7,000 limit. Okay, what if the TFSA contribution room that shows in my CRA account doesn't match to what my calculations say it is? Should I just follow what the CRA account says? No, you should not, because right on the My CRA website, it says our records are not fully up to date. This is updated every year, and there's lags in time to update it, blah, blah, blah. So basically, you keep track of your own records, but then again, you're responsible for being correct, right? So if your calculation's wrong for whatever reason, and it turns out you contributed more than you should have, then you're gonna get hit with interest and penalties for over contributing, right? So if you're not 100% sure, stay on the safe side, go with what the CRA says, because you can always hold them to that and be like, look, that's what you said. Okay, another one, are students eligible for the BC renters tax credit? Yeah, absolutely. So there's in case you didn't know, in BC, there's a renters tax credit, which is basically, it's allowed for students up to, I think, $400. But there's an income threshold, right? Which most students, that's not a problem, but I think like if you're making less than 45 grand, then you're eligible. And it's basically, you just have to pay rent for at least, I believe it's at least 6 months in the year in BC, and you're gonna get that credit. What if I worked in 2024, but I get paid in Jan 2020? Oh, sorry, that's the same question. So in this case, for example, I should file the income for the period November, December 2024, even if I get paid in February. Yeah, like I said, it depends on when you earn the income, right? So if the income was earned in November, December, that's when, you worked the job, you signed the contract, you did the work to earn that income. If it was at any time in 2024, then yes, you're gonna have to file that tax return. Great, okay, so I think we're out of questions. Any questions in the room? Oh, yes.
Just for clarification, so if you've got any award or grants, we file it as our income, but it's not taxed, right?
Yeah, and let me just repeat real quick for Zoom. So question was, if we got any kind of award or grant for as our income, it's not gonna be taxable. So yes, so the criteria for that is you have to be a full-time student, right? And yeah, it has to be a scholarship, an award, a grant, that type of thing.
But we still count it as our total income.
Yeah, so you'll get your T4A slip, right? It'll be on, it keeps saying box 105, I'm pretty sure it's box 105. It'll show up on your tax return as an income, but then in the next page on the deduction side, it'll be a minus the same amount,
All right,
right? So at the end of the day, your taxable income should be still zero.
and will it contribute to RSP?
Yes, yes, I believe it does. I'm almost certain that it does. Yeah, so the examples that I gave that don't contribute to your RSP contribution room would be passive things, right? And so I don't think this is considered passive because you're an active full-time student, right? You earn that income in the course of being a student. So I think it would. I might want to research that to double check, but I'm pretty sure that it would. Things that wouldn't would be, again, interest, dividends, that type of passive type of income. So I think we got everything. There's no other question. Oh, yes.
Yeah, you got this question earlier in the chat about filing for US and Canada, and it was just sorry, not process your answer for that.
No worries.
So with that again,
US and Canada? Okay, so for the benefit of the Zoom, the question is, how does it work filing in both US and Canada? So the way it works is Canada has a worldwide tax system. So in other words, we don't care where you earn income. We want to know about it all, right? So you're going to take your US income, you're going to take your Canadian income, you report it all, and obviously convert it from US dollars to Canadian. And then any deductions incurred to earn that income. So if it was like gig type work, like freelance work, that type of stuff, then you're going to have office expense, you're going to have whatever expenses you reasonably incurred to earn that income, you'll deduct that stuff, and then there'll be a net amount. So you'll file your US return, And then whatever tax you paid in the US, you'll get credit for it here in Canada. Right? So, but keep this in mind, is that Canada will never let you get credit for more than what you would have paid in taxes here in Canada, if that makes sense. So, but typically Canadian taxes are way higher than US personal taxes, so it's not an issue. Essentially, what happens is, Canada's only gonna pay the difference. Like, let's say your US personal tax rate is, I don't know what it would be, like, let's say 20% maybe. So if your personal tax rate in Canada is 25, Canada's only gonna get to tax that extra 5, right? Because you're gonna get a credit for having paid that 20% in the US, right? So once you start getting into cross-border stuff, don't do TurboTax, don't do the voluntary income tax clinic, find an accountant. I think I left my contact info, I can go back to it, but, certainly I'm happy to help with that type of situation, if anybody has questions on that. Oh, and I will just say, I would like to get back to it. I don't know the way to get back to my contact info. I will just say for US, so there's my contact info. And for anybody in Zoom, if you have tax questions, please don't hesitate to reach out. I'm happy to help. So there's this thing in the US called a Roth IRA. And so basically it's kind of like the US equivalent of a TFSA. And so there's this annoying little election you have to file in your first year as a Canadian taxpayer to basically say, hey, CRA, you don't get to tax this Roth IRA. It's like your TFSA. It's a tax-free investment in the US. And then they won't. But almost nobody knows about it, and it has to be with your very first tax return in Canada. So if there were any US citizen with Roth IRAs either on the Zoom or here, please be aware. So first time tax filing. Another question then? Oh, okay, that's good. All right, so there's no other questions. Thanks so much for being here. Like I said, here's my contact. So if you have future questions or need help with your tax returns, I do taxes too. So I would be happy to help. Thanks very much.